Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, this is which episode?
994. I remembered. Okay, so we are marching at breakneck speed toward episode 1000. So you have got to subscribe and hit notification bell so you can get with us to episode 1000. It'll be great. We'll have dancing girls. Todd will do all kinds of crazy things. It'll be fun. At the very least, I'm going to giggle. So this is what you have to look forward to for episode 1000. In the meantime, we are going to be talking about cool things about recessions and foreclosures and have charts and graphs and data. So if you like data, please subscribe and hit the notification bell. So here we go.
Okay, so we've been talking a lot about these forecasts.
Yes.
And the forecasts and how it affects housing market.
Yes.
Okay. So what we're going to do is we're going to go and look. We've got a ton of charts, a ton of graphs, things like that. We're going to look historically at what has happened to housing during other recessions. We're going to look at what happened to jobs during other recessions. We don't even know if there's going to be a recession, okay? Germany has, they already have estimated in Germany they will not have a recession. A year ago, they were supposed to be in a massive recession because remember, they got all their energy cut off from Russia. Oh, they're not getting any gas from Russia. They're not going to be able to heat this past winter. Remember, last summer, Germany was not supposed to have any heat. It was going to completely wreck their economy. And now they're saying, oh yeah, we're not going to have a recession. Our economy's doing great.
Right.
Okay. So what we're going to do is we're going to start with some headlines, and then we're going to talk about housing, recessions, and things like that from a historical standpoint, what happened in the past. And then we're going to dispel a bunch of myths. And then we're going to talk about some practical stuff. Because people are trying to make decisions based on, like I know there's people out there going, I'm going to wait for October 2nd of 2023 because that will be the housing bottom and that's when I buy a house, I'll get the cheapest price.
And that could very well be true. However, will the house that you want be on the market at that point?
Right.
Time will tell. So here we go.
Okay, so here's the first headline. This is from Vanguard. We did this in a video the other day. The housing market downturn is why we view a mild U.S. recession. In 2023 is the most likely. So the housing market. Downturn in the housing market is going to cause a recession. That's what they said, right?
Right, because, so here's the thing. The housing market is a really big section of our whole economic activity in this country, okay? So between the houses that are bought and sold and the houses that are rented, these figures really have an outsized impact on our economy. So we know that 40% of our consumer price index has to do with the price of housing, right? So that's what they're looking at with inflation. We know that housing itself generates a lot of economic activity between the building and everything, all the collateral stuff, right, that goes with housing. So when you're buying a house, there are like 280 people involved in you buying a house between all the title people and the mortgage people and the realtors,
home inspectors,
and everybody else. So that's a lot of economic activity, right?
Yeah.
So that's part of it, and then of course everything that goes with your house, right? Anything from the flooring to the light fixtures, the plumbing fixtures, the landscaping, the appliances, your countertops, your cabinets, all of that. All of that's economic activity. So there's just so much involved in this country that has to do with the with housing, right? Whether you're buying that house or it's being rented. All of these people are involved in housing. So this is why there's so much of a microscope this is why housing gets such an outsized scrutiny in our economy.
Okay, the great financial crisis was caused by housing because housing, there was speculation, there was overbuilding. And new home construction literally came to a standstill. Tons of construction jobs were lost.
Yes, but
a bunch of people got foreclosed on.
Right, but
and then
I
by
disagree
2008,
with you. I disagree with you.
Well, how do you disagree?
So it wasn't caused by housing; it was caused by poor lending practices because that's
the poor lending practices caused the housing.
Right. Well, right. The poor lending practices caused the whole boom of housing and then the subsequent crash. It wasn't housing itself. It was the lending practices.
Right, but the which we don't have now. We don't have those lending
Correct.
practices anymore. They're gone. But the lack of like home builders not building and all that, people just left. Okay. All right. The problem I have with that theory is that Okay, so housing is going to cause the recession.
Housing can't cause recession.
Hold on. Housing is going to cause a recession. And then the recession will somehow cause because housing is doing poorly, this will cause other people not in housing to lose their jobs. And then that will cause housing to go down anymore. It doesn't make sense. We've got data that shows that's not true.
Correct.
But that's not what the Fed says. The Fed actually is predicting a very mild recession. But the Fed is saying, and this is from an article, the banking crisis will tilt the U.S. into recession, said Fed economists. So they're saying, it's the regional banks. The regional banks, what, 3 or 4 have failed?
Well, a handful have failed. There are others that are, clearly struggling as well. And part of that is kind of a self-fulfilling prophecy, right? Because once we had a couple of them fail, then other people took their money out of regional banks and put them in the Wells Fargo and Chase and the big, the too big to fail banks, right? And so that really put these smaller banks in jeopardy further. That's neither here nor there. I mean, we've also heard that it's these regional banks that have done the lending for commercial buildings, like office buildings, and those loans are coming due, or some of those buildings are in default because they're not sufficiently rented and that sort of thing. And then, of course, that's going to tip them over. And we've seen, we are starting to see some of that. We were looking at the All In Pod today, and they were talking about this building in San Francisco that's worth like $300 million.
$200 million.
Okay.
And it's going to go to sale for...
they think that they're going to get like $60 million for it. So basically what they're going to get is they're going to get far less than replacement value for the building.
Oh, it is $300 million.
Okay.
That's what it's worth. That's what they loaned against it.
Right.
And they're going to get $60 million. Right. It's going to go for 20%.
Right. So it's going to be far less than the replacement value of the building. So that'll be really interesting. And even at that, the building's going to be difficult to get... to have it be fully rented because there's nothing going on in San Francisco for other reasons that we've talked about ad nauseum. But the point of this is that so regional banks are the ones who have made a lot of these loans, and this sort of commercial lending crisis is going to have a domino effect for these regional banks. Now, the truth of it is that yes, that will happen to some extent. But what we've learned from history is that they're not going to make the same mistake, I don't think, that they did with residential. When this happened with residential, I think that they're going to come up with better solutions. And I think that the Fed is going to come up with better solutions. We know that the Fed has backstopped banks before, and even beyond beyond the insured limit of FDIC, and I don't see this not taking place again. I think the Fed will step in. So as far as these regional banks causing a recession, I don't know. I'm less than convinced. No. I'm not saying that we're not going to have a recession. I'm just saying that I'm less than convinced that this is going to be the tipping point.
The regional banks do not have enough employees to cause enough unemployment that would affect the economy. No. And the loans don't just disappear or do it. They'll transfer on to somebody else. Somebody else buys the assets of the bank.
Right.
When a bank goes under, people think it's worse than it is. But what happens is the shareholders are wiped out. Anyone who owns stock in the bank is wiped out. All the assets just get purchased by somebody else, and then it's not like you just get to stop making your payment. You still have to make it. It's just somebody else gets to collect it because they bought the assets. And the Fed did, and the Treasury actually sort of backstopped Silicon Valley Bank.
Right. So, what I wonder is if they're going to, if what's going to happen out of this is if you're going to see some of these regional banks form consortiums to support each other. How are they going to mitigate this? Because they all know what's on their books. They all know what's coming down the line. And to sit there and just wait for it to happen seems foolish to me. It seems like they could go on the offense rather than the defense and head this thing off and try to get something going before everything hits the fan.
Okay, so it's not going to be a regional banking crisis.
Nope.
Okay, there's another theory right here. The richest Americans are on a spending spree. It may help U.S. avoid a recession this year.
So I completely agree with that. So remember, the richest Americans are the baby boomers, and the baby boomers are getting older, and they have figured out this magical thing that has never occurred to anybody before, that they can't take it with them. So, so they are spending. They are spending on real estate. They're buying second and third homes. They're buying all kinds of things that maybe they held off buying because they were waiting for something to happen or something to not happen. But they figured out that they're getting older and they may as well enjoy their money. The other thing is that their children are adults, and they're not like young adults. Their children are middle-aged adults. So their children don't need support from mom and dad anymore. So mom and dad are now free to splurge. They're free to live their lives and do some of the things that they've always wanted to do, and purchase some of the things that they've always wanted to own. And all of these things are consumer-driven things, and they are things that contribute to the economy. So the baby boomers, bless their hearts, might be our saving grace.
Here's another quote, for another headline from an article. 2023 U.S. recession now expected to start later than predicted. So they can't even, remember, it was supposed to be...
It was supposed to be last year.
It was supposed to be 2021. We actually had 2 quarters of negative growth, 0.1%. But there were jobs created. There were literally employment rose. Unemployment dropped. It dropped like substantially. So government just said, well, we have this 2 quarters of negative economic growth. The economy did shrink 2 quarters in a row, but we just added a bunch of jobs. So we're not going to count that one, even though we actually had one. We actually had negative economic growth, and we had real estate prices boom. Okay. This feels like when you're trying to catch a flight and they tell you there's a delay and they keep extending the delay. Okay. We were supposed to, you remember in 2021, beginning of 2022, there was 100% chance of a recession. It was 100%. Like, we're going to have it 100%. And then by May, it was, it's going to be later in the year, first quarter. It was for sure. And then by August, you can watch our videos, it was for sure going to happen in the first quarter. Well, first quarter is gone. It's gone. It's in the past. We're in the second quarter. Guess what didn't happen in the first quarter? We didn't have a recession. So they keep kicking the can down the road with a recession.
It's interesting because, if you listen to people and read articles, people are saying that we are in a recession now. I'm like, well, the quarter just started, folks, so I don't know what you're all talking about.
Okay, so here's another chart I want to show you. This is U.S. recession since 1945. If you look at the last 6, and the last 6 are the important ones, I'm going to show you another chart here in a minute. You can see that we had, in 1980, we had a 6-month recession. And remember, these are just the length of them. This is not the depth of like how much negative economic growth there was. Okay, we had the big one, 81, 82. Then we had the 90, 91, and then that was the Gulf War, like happened during the Gulf War, and then the March of 2001. That was the one that basically was happening at that time. Real estate was pretty strong actually back then. Okay, then we have the great financial crisis that lasted 18 months. And then the last one, 2020, it was a couple months, February. They say it was February to April. It was just because of a ton of job losses. Everyone, it was the lockdowns basically, right? Yeah. And we substantially contracted and we grew again. Okay, so remember those two. The 81, 82 was a 16th month recession, and then the other was an 18th month recession, right?
So, but if you looked at that chart, what you saw was that the most common is an 8-month recession, which is actually a pretty long recession. But now they're talking about having a brief recession, which that we had the 1-2 month recession a couple years ago. So I think if we do have a recession, it'll be interesting to see how long that goes. But this thing where, kind of like Todd said, that delayed flight, eventually that flight gets canceled. I don't think that the recession is getting canceled because recessions always come. But this thing where they keep kicking the can down the road, it's amusing. It's not helpful.
Okay, So the big, thing here is that, but Todd, the jobs, people are going to lose their jobs. And when they lose their jobs, they're going to get foreclosed because they're going to stop making their payment or they're going to be forced to sell. Okay. Well, I wonder how many open jobs there are right now, according to the Fed. Well, we have a chart. Right now, according to the Fed, there are about 9 million open jobs. Matter of fact, look at this chart. We have a substantial number of open jobs. Like we have a crazy number of job openings for people. Anybody who lost their job would have no problem going and finding another job. Matter of fact, this is why we have inflation. We have inflation because we have so many open jobs, people won't take them. So we're having to raise the amount of pay they pay people to get people that have stopped working, to come back into the labor force, or to keep people from leaving their jobs. We have wage inflation. And if you look historically, during the last two recessions, the number of job openings were never anything like this. Mm-hmm. So yes, in 2008, you can see down there that the number of job openings plummeted, right? Mm-hmm. But right now, there's a ton of open jobs. And even if it plummets, even if it gets cut in half, that would be more jobs than we have in a healthy economy. So people that lose their jobs would get jobs. Now, Juana, what if I were to tell you that there really aren't substantial job losses during a recession?
Well, I think that a recession and job losses do not always go hand in hand. So let's kind of touch on that.
What is a recession? A recession means how many jobs have to be lost before we have a recession?
None. Because remember, a recession has to do with our gross domestic product, not with job loss or job creation. People believe that there are job losses when we are less productive, but that's not necessarily true. That there are other reasons why our gross domestic product, is not strong in a quarter. And a lot of times it has to do with maybe the monetary policy. So what I mean by that is maybe an extremely strong dollar, so we're not exporting as much. So there are lots of reasons why our gross domestic product is not that strong. But jobs do not play into that directly.
Okay. This chart shows month by month for the last 20 years the number of layoffs and discharges by month. Okay? It's literally 2 million a month every month. Every month, 2 million people get told you're gone because certain industries have changes, companies fail, and then what do those people do? Do they just quit working and say they're forced to sell?
No, people switch jobs. I mean, look, I think in all of our lives, there are people who have recently started new jobs, whether they left their previous employer voluntarily or whether their previous employer bid them goodbye. Either way, they left their previous employer and have found new jobs. And a lot of times, certainly right now, a lot of people have actually found better paying jobs, which kind of plays into the whole thing where people saying, well, but if people lose their jobs, they're going to have to take a worse paying job. Not so fast. Not so fast. Look at all these jobs out there. And before you say that these are all low paying jobs, again, not so fast. There are lots of good paying jobs out there. And people who are capable don't necessarily go out and get another job. Sometimes they decide to go in competition either with their previous employer or to start something completely different and create something, start a business, whatever. So just because somebody has lost their job doesn't mean that they're going to go out and get a lesser paying job, doesn't mean that they're going to go out and seek another job. There are all kinds of other economic activities that they can engage in, which is part of the reason why we have so many jobs available, because people have walked away from their jobs throughout the pandemic because they have figured out that there are other ways that they can be economically viable besides working for someone else. And that's what you're seeing in those numbers. Those high number of jobs available are a reflection of a new economic trend where people are choosing to do other things besides work for someone else.
Okay. you can see clearly on this chart, if you go back to the 2001 recession, there were not a massive amount of job losses other than what normally happens. Great financial crisis. You can see that next one. It was more than normal, but it wasn't substantial. Okay. And then 2020, that was COVID. That was the COVID. That was the most ever job loss. Basically, a bunch of people, everyone that worked for restaurants or cruise ships or things like that, were all told, "Hey, don't come to work because we're closed." Right? Hairdressers, those types of businesses were shut down. If you worked at a grocery store, you were still fine. Or if you had some jobs, you still went to work. If you had some office jobs, were told, "Hey, our office is closing," and everything. So, and even though you didn't work in the office, sometimes you work remote, so you still technically had a job, right? So the theory that the recession would all the job losses. Now, people are saying, "But Todd, what about all the tech job losses?" Guess what? They're on this chart. Look all the way bottom right. That's 2022. This chart goes to February 2023. So all those end of 2022 job losses show up on this chart. It's actually the job losses right now historically are less than they've ever been. We're losing under 2 million people. We have less than 2 million job losses and discharges. It's lower than normal. And remember, we have over 9 million open jobs for people, right?
Right. And the thing to keep in mind, I know that we see lots of headlines of, Facebook laid off people or whomever laid off people, and that's fine. But that's when you look at it in the totality of discharges, that's what Todd is talking about, that we are less than 2 million a month. So, you have to kind of look at, and I say this a lot, look at whatever it is that we're talking about in context. And that's what we're trying to give you is context.
Okay, here's another chart for you. So people are going to say, but the people will lose their jobs and they'll be forced to sell or be foreclosed.
So two things. One, they're not going to be forced to sell. No one's going to, put a gun to their head and say, okay, with your pink slip, here are the foreclosure documents. That doesn't happen.
How can you afford your $1,100 a month mortgage payment at 2.75% if you do not have your job?
Okay, so a couple things.
There's no other jobs to get. There's no jobs in a recession. In a recession, the jobs, if there are companies hiring in a recession, they have to now say we can't have these jobs anymore.
Not true.
Are you sure about that? Because that's what they're telling. That's what people think.
No.
People think that recession means everyone loses their job and there are no new jobs.
No.
Those 9 million jobs would just disappear tomorrow.
No. The jobs will still be there. Whether they're jobs that people want to do is another matter. But when somebody loses their job now they have choices. They have choices to maybe relocate somewhere else where there's another job, get another job in the same area, work remotely from their present home for a company either locally or elsewhere. There are unemployment benefits. People do have savings. People can access for hardship their 401ks to help them make ends meet. There are all kinds of reasons and ways that people can still make ends meet until they find another job. The other thing is we are not necessarily, none of us live in a vacuum, and we do have either life partners or family or friends or whatever that can help us. And there are 9 million jobs. Again, you may not go out and get the job that you want, but there is a job that you can take in the meantime to help you make ends meet until you get the job that you want.
To the people who believe that foreclosures would immediately happen and the housing market would crash this year, like in the middle of the recession, if you look back to the left of this chart, 2007, it literally, the amount of time it took to foreclose was nothing. Right now, Q1 2023, the average days to complete a foreclosure is 950 days. That is years. That's between 2 and 3 years, which means even if you stop making your payments today, it's still going to take 2 or 3 years before your house becomes a foreclosure. Now, Juana, in the third and fourth quarter of 2020, we had 3 or 4 million people who basically had stopped making their mortgage payment. Mm-hmm. They went to the banks. They either got the loan added on to the end, or they they were told just make up the payments, or they got some kind of modification or something. What percentage of those people would you guess 2 years later already have completely satisfied and come 100% current with their loan?
So I think that whatever workout plans were done, I think probably almost everybody has gotten everything kind of squared away, whatever that means for them, whether they sold a house and that made the loan whole, whether they had a workout where the missed payments were put on the back of the loan, or they had some other arrangement made. But I think that almost everybody made good and is all square with their loans.
Here's the data. If you go down there to 2020, quarter 4 and quarter 3, 1 year after their modification, 93 to 94% of them were fully back in
good standing.
In good standing, and then a year after that was 96 or 97%. These are the houses that you all heard about. That when we said there were 3 or 4 million houses that people had to make their payments. And then people forgot about it and thought, oh, these houses are these are the foreclosures the banks have been holding on to. These houses never got foreclosed. They all went back into good standing. We know the foreclosure numbers. There are no foreclosures. Literally, the number of foreclosures are the lowest we've ever had, ever. Okay? So there's not going to be a ton of job losses in the recession. Do you know what the 1 and 2 industries that lose jobs in recessions in general?
I don't.
Travel and entertainment. Because people, that's the first thing they cut out. They cut out their trip to somewhere or going to the movies or something like that, right? Those are the things they generally cut out. Guess which 2 industries are booming the biggest right now?
Travel and entertainment?
Absolutely. Matter of fact, airlines are growing like crazy. They're hiring people like crazy. They're trying to satisfy the massive demand. It does not look like there will be any travel industry or entertainment industry jobs lost in it. All that's going to happen is the economy just isn't growing as fast as people need it to. Okay.
I think it'll be interesting to see because whenever the recession does materialize, I think it'll be interesting to see if it follows the patterns of the past, because I think the pandemic has caused us to rewrite a lot of our life scripts. So I think it'll be interesting to see how people react in a recession.
Well, if we're in it already, if we finish the second quarter and they go back and say, oh, we had negative growth in the second quarter, we've had 3 months in a row of home price increases nationally and in Las Vegas. So this would be the worst recession ever. But actually, a recession does not mean falling prices. Here's the chart. These are the last 6 recessions. Now, remember that 81 recession I showed you on the chart that was like 16 months long and it was really terrible? It was like a bad recession. Home prices went up 3.5% in that recession. The COVID recession, 6%. The only recession they substantially went down was the 2008 housing crisis recession. They said it was a great financial crisis. It was the housing crisis recession. It was lending, overbuilding, building stopped completely. It was pretty bad. That's not going to happen again. We do not have a glut of homes. We have the highest percentage of homes that are free and clear owned that we've ever had. We have 99% of all houses out there have under 6% rate, which is historically far below the average. We have the opposite problem. We don't have enough. We're 6.5 million housing units short. I'm not saying home prices are going to go up in the fall. They generally go down in the fall. Most of the estimates is they'll go down about 5%. They go down 3 or 4% every year from spring to fall. Just in the fall to spring, they tend to go up more than that. That's how home prices go up. So the idea that the recession would make home prices fall and you're going to wait till the recession to buy because it'll be cheaper, it might not be. Just saying, it might not be.
The other thing is the house that you want may not be on the market.
Right.
So lots of charts, lots of good stuff. Hope you liked it. Hope you got something out of it. We appreciate you being here. Please subscribe, hit the notification bell, like the video, share the video. Leave us a love note and tell us what you think. Tell us what's going on in your market. Tell us that you're going to be there for the 1,000th video. And we appreciate everybody watching. And we appreciate the people who tipped us. I heard that we got a tip on a video.
We got a tip.
Yes, we did. And we appreciate that. That was very kind of you, very generous.
It was $10.
$10. I like it.
I know.
Bring it on. So thank you for watching, and we'll see you on the next video. Bye.
Bye.